Can you really have $1.2 million in assets and retire poor in America? Let's see what the numbers say about how the average American family or household might use our base and boost strategy for retirement. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our base and boost mini-series. So, it seems that the average American family or household that is still working has a pre-tax income of about $10,000 per month and assets of about $1.2 million overall. This is according to the latest publicly available data from the U.S. Census Bureau, the Social Security Administration, and the Triennial Fed Consumer Survey at the time of this taping on May 14th, 2026. Now, these numbers look not too bad on the surface, but they look much less okay when you dive deeper into them, and particularly in the context of retirement and our Diamond NestEgg base and boost strategy. In fact, based on these illustrative sample numbers that we pulled from the 3 government sources, the potential average retirement gap in the U.S. is about $33,600 per year. So, let's go into a bit more detail into these numbers now and see how dire or not this situation may be in our country, and how our Diamond NestEgg base and boost strategy may help you to better prepare for a hopefully long and financially sound retirement. Here are the 3 topics I'll be covering today. 1. Where do the investments that we've discussed so far this week fall under our Diamond NestEgg base and boost strategy for retirement? 2. What might some illustrative sample numbers look like for the average American family or household? This is where we'll be answering the question, can you really have $1.2 million in assets and retire poor in America? And 3, how might the average American family or household bridge the retirement gap using our base and boost strategy? Let's dive in now, folks. Where do the investments that we've discussed so far this week fall under our Diamond NestEgg base and boost strategy for retirement? As a quick recap, here are the 2 key components to our Diamond NestEgg base and boost strategy. The base part, this locks in the required income to cover your everyday essential living expenses in retirement. The base part of the strategy should mainly be oriented towards safe, stable, and predictable income that lasts a lifetime. These include Social Security, a private or company pension, if any, and annuities that guarantee a lifelong income, and maybe laddered longer-term treasuries or similarly safe non-callable bonds. For example, for an investor who is in the highest tax brackets and able to find non-callable AAA munis that fit his or her time horizon, these might be a potential possibility as well for the base. The boost part, this should protect you against inflation, help build generational wealth, and or be a source for discretionary spending. For example, for the special people, things, or causes in your life. The boost part is where you may want to take some controlled risk for possibly higher returns and or income, but it may fluctuate over time, so you would not necessarily rely on it for your everyday essential expenses like you would for the base part of the portfolio. As we talked about earlier this week, these may include higher yielding bonds, which also generally means lower rated bonds, and preferred stocks, as well as common stock, real estate, structured products, and other potentially riskier assets, whether held individually or as part of an ETF or fund. In a nutshell, the base part of the portfolio should be guaranteed. It's really all about a safe, stable, and predictable income that lasts a lifetime with the base. No experiments or unnecessary risk-taking here, whereas the boost part is not guaranteed. When implemented properly, our Diamond NestEgg base and boost strategy may help you in building out your sleep well at night portfolio, just as we expect it to do for us at some point in our later years, because you know you'll have enough income to cover your day-to-day basic living expenses for as long as you live. And at the same time, you may still be able to invest in some higher yielding assets, whether that may be for higher returns, income, and or inflation protection in the boost part of your portfolio. And if you're interested in joining a trusted private community of like-minded folks and learning more about how everyone is building out their base and boosting the rest of their portfolio, come on over and join the growing member community in our VIP investment club, where these conversations are happening practically every day. As requested by our members, we'll be diving deeper into international bonds, preferred stock, and covered calls for higher yields, as well as everything else we talk about regularly here, like treasuries, agencies, and so on. There's only 2 days left to save. Use coupon code INCOME2026 at checkout to get $100 off of a private VIP Investment Club membership before Sunday, May 17th, and just in time to join this month's Member Live on Memorial Day weekend. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more, or this Bond Course Bundle button if that's what you're interested in. I've also linked everything below this video for your convenience. And let's move on now to the next part of today's discussion to see if you can really have $1.2 million in assets and retire poor in America. What might some illustrative sample numbers look like for the average American family or household? As I mentioned towards the beginning of this video, it seems that the average American family or household that is still working has a pre-tax income of about $10,000 per month and total assets of about $1.2 million. Of this $1.2 million in assets, roughly $470,000 would be the value of the primary residence, and about another $330,000 would be in retirement accounts. With that background, let's try to fill in some numbers to see how the base part of our base and boost strategy might work for the average American family or household. And please keep in mind as we go through this mathematical exercise that Diamond NestEgg is not a tax advisor, nor are we your financial and/or annuity advisor. Please always consult with your trusted tax, financial, and/or annuity advisor one-on-one for your personal situation. So, you may recall from the first video in our Base and Boost mini-series that to start defining and building your base, you would first have to add up your everyday essential living expenses, including all your basic out-of-pocket expenses, such as housing, food, transportation, utilities, health and prescription drugs, etc. Because these are your essential day-to-day running costs only, we would exclude all discretionary spending for things that are nice, but not really necessary, such as travel, entertainment, and gifts. Plus, we also assume that you would stop contributing to retirement accounts and other savings when you retire. So, here's some illustrative sample numbers for what the average base might look like. On the cost side, let's take our best and hopefully not unrealistic assumption and say that an average household will need about 60% of their pre-retirement earnings to cover their essential living expenses going forward in retirement. If we start with this pre-tax income of $10,000 per month on average before retirement, 60% would give us roughly $6,000 per month in average essential expenses that we need to cover every month. On the income side, the first building block here for a lifelong guaranteed income would be Social Security. We'll put $3,200 in here, about the average for a couple where both are already in retirement. For comparison, the average for an individual Social Security check is currently about $2,000 per month. We also assume that in this case, there's no private or corporate pension. As we often say on this channel, great if you have one, but this is getting rarer in current times, so we can't count on any contribution here. Which means we have a not so small gap of $2,800 per month that we need to close if we want to maintain this current standard of living, bringing us nicely to the next part of today's discussion. How might the average American family or household bridge the retirement gap using our base and boost strategy? So the question is, if we have this gap of $2,800 per month or $33,600 per year, how might the average American family or household bridge it using our base and boost strategy? Let's run a first reality check, so to speak, and look at two popular options, annuities and a treasury ladder. Please do keep in mind that all these numbers are approximate and pre-tax and for illustrative and educational purposes only, and that past performance is not indicative of future outcomes or results. Here's an example of how much you might need to invest to bridge the gap on May 14th, 2026, the time of this taping. A treasury ladder that keeps paying you $2,800 per month or $33,600 per year from a combination of interest payments and principal repayments for 20 years may require an investment of approximately $440,000. For 25 years, the required investment amount might be even higher at about $495,000. If you retire at 65, this would cover you until you turn 85 or 90, respectively, which would be roughly in line with the life expectancy of 83 for a man and 85 for a woman at this stage of their lives. A SPIA, a single premium immediate annuity that keeps paying you that same amount of $2,800 per month or $33,600 per year for as long as you live, might potentially cost you anywhere between about $480,000 from an A-plus rated insurance company to about $520,000 with an A++ rated insurance company. With the SPIA, you would eliminate longevity risk, whereas with the Treasury ladder, once the money is gone, it's gone. And if you live long enough, which we all hope, of course, you'd have to make sure you have other sources of income left. Do note that these SPIA numbers are for a 65-year-old couple living in Florida. It's joint life with death continuation at 100%, meaning that after the first spouse passes away, the surviving spouse would continue to receive the $2,800 per month until his or her death. These SPIA numbers also assume a cash refund option, meaning that if both spouses pass away before the initial premium has been fully paid out to them, the unpaid portion of the premium will go to the couple's designated beneficiaries. And as a point of reference, A++ is the best rating for an insurance company, according to AM Best rankings, and A+ is the second best rating. Your numbers may be different depending on a number of factors, including your age at issuance, state of residence, chosen insurance carrier, and so on. Remember that your personal rate and payout is not locked in until you sign your annuity contract. And as always, if you want to see what the annuity numbers might look like for your individual situation, email us at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists who can find the best annuity solution for you. So, to recap, based on our illustrative sample numbers, the average American family or household may have to bridge a gap of $33,600 a year, or $2,800 per month, to cover the base part of their portfolio, after taking Social Security into account. At the time of this taping, to close this income gap with a Treasury ladder, it may require an investment of between approximately $440,000 to $495,000 plus, depending on the ladder's time horizon. But once the money is gone, it's gone. There's no guarantee. With a SPIA, a single premium immediate annuity, this might potentially cost you anywhere between about $480,000 to $520,000, depending on the credit rating of the insurance company. But the income is guaranteed for life. The problem, as we mentioned earlier, is that the average American family or household has only approximately $330,000 in their retirement accounts, which means that they may have to find some other source of cash if they want to cover their base via either a Treasury ladder or an annuity. And some might even be able to do that by dipping into assets such as bonds, stocks, or funds that they own outside their retirement accounts. The second option is, of course, to take a long, hard look at the expense side of the equation. Maybe consider moving house or even state, for example. Or, and that's the third option, they may decide to take a bit more risk with their investments for a bit more potential return, which may help to narrow the gap, assuming that they can get themselves comfortable with investing beyond treasuries and top-rated insurance companies. Personally, this third option is not something that Marcus and I would normally do in the base part of our portfolio. But if our gap looked like this in retirement and we were not able to lower our essential living expenses any further, or we were not able to find the cash to build out a more or less guaranteed income stream in retirement, either for a safe Treasury ladder or SPIA, the reality is that we might have to move up the risk spectrum and look for potential higher risk, higher return investments. And I'm not thinking of sheer speculation here, but more of controlled risks, like maybe adding some bonds that are still investment grade, but maybe not at the very top of the rating scale. That said, everyone's financial journey is different, and if you're interested in joining a group of like-minded savers and investors who are working towards building out their base, as well as looking for higher yields in the boost part of their portfolio, come on over and join the growing member community in our VIP Investment Club. There's only 2 days left to save. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP Investment Club membership before Sunday, May 17th, and just in time to join this month's Member Live on Memorial Day weekend. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more, or this Bond Course Bundle button if that's what you're more interested in. I've also linked everything below this video for you. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again soon with more brand new wealth building content for your financial journey.